Hello, everyone. My name is Matthew. I'm the coordinator for University Center here, and this is Dr. Joseph Pittuck. I want to welcome everyone to Dr. Pittuck's webinar about the digital asset industry. Joe is a software entrepreneur with valuable knowledge about the industry that I think we're all going to find valuable today. I just want to remind everyone that this is a part of our University Center webinar series. I'll be leaving a link in the chat to our entrepreneurial capabilities certificate page on our website, where you can view other seminars from the past. And if you complete 7 of the webinars and 7 of their corresponding quizzes, you'll be able to earn an entrepreneurial capability certificate, which I would highly encourage everyone who hasn't yet to do. So I'll be sure to leave that chat in the chat below. If you have any questions during the presentation, feel free to leave those in the chat. Joe will be able to answer them in between slides, and then we'll also have a dedicated question section at the end of the presentation as well for about 20 minutes. But with no further ado, I'll go ahead and turn it over to Joe, and he'll take over from here.
Cool. Hello. My name is Joseph Pitluck, and today I'll be speaking to you about the opportunities and challenges faced by US-based digital asset companies in 2022. For entrepreneurs interested in starting or growing a digital asset company, it's important to understand the unique risks associated with this industry. I'll be sharing some case studies and best practices for managing these risks, as well as discussing the impact of recent legislation on the digital asset industry. So what exactly are digital assets? Most of us think of Bitcoin or NFTs. Various jurisdictions have attempted to define digital assets. Wyoming defines a digital asset as a representation of economic, proprietary, or access rights that is stored in the computer-readable format. In other words, digital assets represent ownership of something, either real or virtual, that can be stored, transferred, and traded without the need for a trusted intermediary. So let's talk about what a digital asset company is then. Essentially, a digital asset company, they come in many different shapes and sizes. They could be a traditional financial institution, like a bank or a credit union offering digital asset custody services. It could be a startup building decentralized finance protocols on Ethereum. Or it could be a decentralized autonomous organization that helps creative artists mint NFTs. Entrepreneurs interested in starting a digital asset company need to consider what type of business they want to build, the associated regulatory requirements, and how they plan to generate revenue. They also need to consider some unique risks. So what are the unique risks faced by digital asset companies? There's many risks that digital asset companies face. 3 that are pretty big that I want to talk about are transactional, compliance, and counterparty risk. With transactional and operational risk, essentially this is a risk of loss resulting from fraudulent or unauthorized transactions, system failures, or human error. Compliance risk for a startup in this industry would be the risk of violating laws and regulations, which can result in sanctions, fines, or even jail time. Counterparty risk is essentially the risk of loss resulting from the other party to a transaction not fulfilling their obligations. And I'll go through each one of these risks in more detail here. So let's talk about more about transactional operational risk. The biggest risk in this industry is startups essentially mismanaging private keys, either losing them or having them hacked and having someone else have essentially unauthorized access where they're stealing crypto funds. Digital asset transactions are generally irreversible, so it's important to have robust controls in place. A lot of these controls that you can implement are, for one example, be cold storage of private keys as best practices for mitigating cyber attacks. Additionally, the nature of digital asset transactions mean that there's a higher risk of loss from misuse or theft compared to traditional assets. For example, if private keys are stored in an online digital asset wallet, again, there's a higher risk of loss from cyber attack, as these keys can be compromised by anyone with access to the associated network. Compliance risk. As you can see on the slide here, this gentleman obviously didn't take compliance too seriously, and you can see now they're an inmate. So compliance risk is really the risk of violating laws or regulations. The digital asset industry is still largely unregulated, which poses a compliance risk for companies operating in this space. In the United States, the Securities and Exchange Commission has been clear that digital assets may be considered securities and therefore subject to securities laws. However, the SEC is not yet to issue specific guidance on how these laws apply to digital assets. This leaves digital asset companies in a state of limbo, unsure of what exactly they need to do to comply with securities laws. Additionally, there are money laundering risks associated with digital assets, as they could be used to pseudo-anonymously send and receive payments. Digital asset companies must have robust anti-money laundering compliance programs in place to mitigate these risks. Counterparty risk. There's a saying in the industry, not your keys, not your crypto. Just like a bank run, when a crypto intermediary halts withdrawals, it's a sign that they're essentially insolvent. During a crypto run, customers will line up to withdraw their money from an exchange. It might be an individual customer. It might be your startup that was relying on this exchange to hold your funds. If the exchange doesn't have enough cryptocurrency on the hand to fulfill all the withdrawals, they might try to take out a loan to cover those. If the exchange cannot raise enough money to cover the withdrawals, it may ultimately fail. And unlike banks, there is no lender of last resort for crypto. So once an exchange fails, there's no guarantee that customers will ever get their funds back. Again, hence the term, not your keys, not your crypto. So speaking of bank runs, I sort of want to highlight Wyoming special purpose depository institutions. In 2018, the Wyoming legislature essentially passed a bill creating a new type of institution for holding digital assets. In order to obtain a license, these entities need to meet certain requirements around operational risk management for digital asset custody, including having robust internal controls and procedures for private key management. These banks are full reserve custodial banks. This means that they're required to hold 100% of customer deposits in reserve at all times, plus additional funds reserved for operational costs in the case of a bank run. Let's go to digital assets and bank accounts. Surprisingly enough, even if you're a digital asset company, you still need a bank account. There's many reasons why you would need a bank account. First and foremost, if you're a business in the United States, you need a bank account to pay payroll taxes. If you can't pay payroll taxes, you essentially cannot run a business here. This was actually a very big pain point in 2018. It's actually happened to one of my companies where essentially every digital asset startup in the United States was having their bank accounts closed because of perceived risk. And again, that definitely creates some problems, especially if you're trying to pay for professional services, if you're trying to pay your employees, it makes things very difficult. So it's very important to have very good relationships with your bank if you're a digital asset company. All right, I'll talk about insurance here. But as far as insurance, digital asset companies have historically had a difficult time obtaining insurance. Much of it stems from insurance companies being unable to underwrite risk in the industry. Some companies have chosen to insure themselves instead. However, this is changing as insurance companies are becoming more interested in profiting from the industry's growth. Digital asset companies typically seek insurance for things like external and employee theft of funds, as well as protection against claims of negligence. This demand for insurance reflects a positive step in the evolution of the digital asset industry, which has been working to gain credibility of both the public and investors. All right, let's talk about the impact of regulation on digital asset startups based in the US. The impact of regulations on startups can be significant. We talked about SEC already. For example, the SEC has put pressure on many startups by issuing cease and desist orders and imposing fines. The SEC's actions have caused some startups to shut down and others to change their business models. In addition, the CFTC is beginning to regulate digital assets, and this could have a major impact on startups that are involved in this space as well. Another case study here, we'll talk about the Responsible Financial Innovation Act that's currently being passed around in Congress. This act creates a clear standard for determining which digital assets are commodities and what types are securities, providing clarity and structure for businesses and regulators. It also assigns regulatory authority over digital asset spot markets to the CFTC. Defines and creates requirements for stable coins, imposes disclosure requirements on digital asset service providers, requires a study on digital asset energy consumption, directs the CFTC and the SEC to study and report on the development of self-regulatory organizations. I actually, it's quite a comprehensive list here. I won't go through it all, but it's essentially an overarching bill that provides enough regulatory clarity to give U.S. digital asset startups a clear advantage in staying here and running a business here. So I'll just briefly touch over building a culture of compliance if you're in the digital asset industry. There's a few things you could do to build a culture of compliance, especially if you have some resources here as a startup. One, hire a compliance officer. Having somebody in charge with compliance, especially of digital assets, is definitely critical. Implementing policies and procedures. You need to have clear policies and procedures that will help everyone in an organization understand what is expected from them. Employees should be trained on policies and procedures regarding digital assets. You could do training through online courses, in-person seminars, lunch and learns. And once you have policies and procedures in place, it's important that you constantly keep updating your compliance protocols and procedures. So I'm getting through all the nitty-gritty stuff. I'm about to highlight or here to discuss some fun stuff here. So I'll go to this next slide. Decentralized finance. This is something that's actually quite interesting to me. I don't know how many of you folks have heard about DeFi. Essentially, it's a shift from traditional centralized financial systems to peer-to-peer finance enabled by decentralized protocols. Decentralized finance offers a compelling alternative to traditional finance because it's built upon open protocols that are accessible to anyone with an internet connection. This infrastructure enables the creation of new financial instruments and applications that can be used by anyone, anywhere in the world. Decentralized finance has the potential to democratize access to financial services and unlock trillions of dollars of value for individuals and businesses. By eliminating intermediaries and middlemen, decentralized finance can reduce costs, increase transparency, and create new opportunities for economic inclusion. We'll jump into Dows. What is a DAO? DAOs are what is known as decentralized autonomous organizations. In a traditional business, executive members exclusively decide how corporations run, while managers carry out these orders to employees. However, in a DAO, each member has an opportunity to influence the organization by proposing changes to be voted on by other members, including governance tokens. This system makes it possible for a DAO to mobilize capital to achieve a collective goal without the need for a centralized authority. Anyone can participate in a DAO if they hold the organization's tokens. These tokens are used to vote on proposals, with each member having a say proportional to the number of tokens they hold. This system is designed to align the interests of token holders with the success of the DAO. All right, well, let's talk about the future of digital assets. President Biden recently signed an executive order on the responsible development of digital assets. The order recognizes that digital assets have far-reaching implications in areas like data privacy and security, financial stability, crime, national security, human rights, energy demand, and climate change. Therefore, the order calls for coordinated interagency efforts to further technological advances and payment innovations in this area. Speaking of the future of digital assets, I want to briefly discuss Estable Coins. Estable Coins are an idea that came about on a paper that was just released. The research came from Livermore Laboratories, and it's definitely interesting. I'll just highlight a little bit of it. Essentially, Estable Coins are a new type of cryptocurrency that is backed by kilowatt hours of electricity. This provides a more stable value for the currency, as is pegged to the price of electricity. By making use of statistical mechanics and information theory, Estable Coins can store and transfer free energy between anonymous, decentralized parties without requiring any centralized authorities, trusted custodians, or even conventional infrastructure. An stable coin does not transmit electricity through conventional power lines, but instead transfers free energy solely through the communication of information, all without violating thermodynamics laws. The concept behind stablecoin is built upon the fact that free energy can be transferred by the transmission of information alone. This has significant implications for applications that require electricity consumption in remote locations, far removed from any electricity grid. Lawrence Livermore researcher Max Murdalo explained, an anonymous party can mint an e-stablecoin token with the input of roughly 1 kilowatt hour of electricity. They can then transact with a digital token like any other cryptocurrency, or even turn it back into usable electricity, all without the need for electrical power companies, electrical transmission lines, permissions, or authorities. It is a trustless system from top to bottom. Present challenges include developing efficient Cell-Zard machines, reversible computers, and improved data storage capacity. Nonetheless, each of these challenges is also an area of active research for independent applications. Looks like I'm going through this all pretty quickly here. So as far as summary, digital asset startups face unique risks and challenges that require a different approach to banking, insurance, risk management, and compliance. Yet building a startup in this industry can be quite rewarding, so long as you understand the risks and challenges. All right, and yeah, I'm happy to answer any questions here. All right, looks like I see some in the chat here.
Yeah, Joseph, if you'd like, I can go ahead and read them out loud to you as they come in the chat.
Oh, no worries. I see it here. It looks like from Cecilia, do you see digital assets playing a bigger part in the economy in the future? I heard there are some countries at this point, mostly third world, that already use Bitcoin as one of their main currencies for sales and trade interactions. Right now, it seems that the biggest concern is actually coming from central banks. Even Honorable Chairman Jerome Powell of the Federal Reserve has said that it's possible that central bank digital currencies may play a role in maintaining the dollar status as a reserve currency of the world. So Bitcoin is definitely obviously one of the most popular ones, but again, central banks are all actively looking towards central bank digital currency products and launching them as far as they see it as the future. So I don't know if that answered your question, but I mean, it's definitely a push from the global financial system on building out these new payment rails. All right, this question's from Savannah. How did you first get into digital assets? Well, interestingly enough, I'm a dentist by trade. I got into real estate and I started opening some shared office spaces, co-working locations in Albuquerque. One of the neat things about the co-working spaces is that you can use essentially a phone app to open and close the doors. And we thought, well, wouldn't it be interesting if you could open the door using tokens, like a laundromat, having tokens. And if you don't use it, you could just trade out the tokens to someone else. So that's essentially how I got started in the crypto. Long story short, at one point, our bank account started becoming closed because of, we were involved with digital assets. So that's essentially how I got started with this whole industry. All right, from Cecilia here. There are so many digital asset companies out there. What are some of your recommendations for creating a niche that'll set your digital asset company apart, especially in an NFT digital art realm? That's a good one. I think really I think one of the best ways to go about this is really understanding customer pain points. I mean, just like with any entrepreneurial venture, if you build something, you can build the most amazing product, but if it doesn't really solve a pain point, or if nobody cares or hears about it, it doesn't really help anybody. So I'd say the biggest differentiator is going to community events, listening or reading up on forums, and just really, I mean, just like with anything else, it's solving a pain point. Building a product that people want is going to help you differentiate yourself from everybody else. Okay, wonderful. All right, Stacy. If just curious what the role of how's it going? Just curious what the role of physical bitcoins will be, given that you're describing a currency that is digital. Physical Bitcoin. That's an interesting question there. I guess I don't know if I'm going to be able to answer your question here. I'm assuming if you're talking about maybe, are you talking about like something analogous to cash, or are we trying to think what the if you're talking about physical bitcoins as far as the cash currency is in a pocket. Should carry bitcoins in my wallet? Well, you can always have a mobile wallet, a digital wallet here that has just enough. You want to store your whole life savings on your phone, but maybe you have enough to pay for dinner or something. And there are some places like in El Salvador where you pretty much can go to McDonald's and buy a cup of coffee with Bitcoin using your phone. Cecilia, what are some recommendations? Let's see, let me scroll up. What are some recommendations or resources you would point someone to if they are considering starting up a digital asset company? Again, there is a local group here in Albuquerque, a cryptocurrency meetup. I don't have the link, but they have an active Telegram group as well. I think just networking, going to events, going to developer conferences, for example, just surrounding yourself with as many people in the industry as possible is probably the best way to get started on it. All right, Ariana, would more regulations essentially help protect consumers from large drops in a stablecoin's value? For example, if Terra Luna recently experiencing something similar to run on a bank, I definitely think regulations would protect consumers. My personal thoughts are, I feel that companies that issue stable coins should essentially be banks. Banks are one of the most regulated institutions that we have. With some of these other companies, like with Tether, a lot of the backings for their coins weren't necessarily cash deposits, but commercial paper of unknown quality. So it's having banks issue stable coins means you have regulators being able to really dive into again, like what's supporting what's underneath a stable coin, what's supporting it, what percent is a cash on hand, etc. So I think regulations would definitely help in this industry. Hey, all right, we got the link here in the chat. That's good, perfect. Good. Thank you very much for that. All right, yeah, happy to answer any more questions here. Yeah, I think we got through this presentation a lot quicker than I thought, so.
Well, if everyone's asked all the questions they feel like they need to, of course, feel free to put more in the chat as I talk, if any more come up. But I'd really like to thank you, Joe, for coming and talking to us about digital assets. It's obviously a widely emerging and exploding space. So it's always good to hear from somebody that has a lot of experience in the industry. I'd like to encourage everyone again to look at all the links in the chat. And if they haven't already, register for our entrepreneurial capability certificate. Again, we at University Center are always trying to bring you informed and good information through that series. And we have a bunch from the past that would also be just as interesting, just as fascinating, that can lead you to getting that ECC certificate that's so valuable. Joe, it looks like Stacy's asking about ABQ Bitcoin Network. Do you know anything about them?
And I should. I feel bad that I don't actually. I've seen in the Telegram chats, but I haven't actually participated in that meetup.
Okay. Looks like Ariana put in another question just now.
Oh, okay. Yeah. Economics and professors regarding cryptocurrencies. There's actually a really good book. I'll type it. I'll have a link. I believe it's called the Bitcoin Standard. Yeah, that one's actually a pretty good book. Actually, if you're not a fan of it's maybe I just don't want to give it away. I think that's actually a pretty good book that would I don't know. Yeah, economists are interesting, so I'll just leave it at that. How about that? How quickly are fake currencies and scams? Jessica, let me try to answer your question there. I think you could answer in two parts. One, as far as fake versus real cryptocurrencies, the thing with these protocols is anybody can launch something. I could launch something that says Bitcoin. You know, I can copy everything, but it's really like, who are the users in the network? If it's not popular, if nobody knows about it, nobody's going to use it. So, but I mean, to call something fake is, these systems don't recognize what's real and what's fake, I guess you could say, as far as launching a coin. So that's sort of interesting. It's the second part, as far as scams, there's always going to be scammers. It's just, if it's not, cryptocurrency, someday it'll be, something else, something new. So I don't have an answer to, as far as, stopping these scams, or what's the rate of scams lately compared to beforehand. Hopefully I answered your question there, Jessica. Yeah, good.
Well, are there any more questions for Joe? Now we're in the question section. You could probably also just turn on your mic and ask also, just so people know. But okay. Well, again, I want to thank you, Joe. And again, I'll refer people to our entrepreneurial capability certificate. And yeah, thank you everyone for attending. I think this was really good.
Yeah, thank you everybody for coming in to listen, take some time out of your day today to hear me talk. So I really appreciate it. Thank you very much.
All right, Joe, we thank you for your time. I'm going to go ahead and be closing the meeting now. If anyone has any other questions, feel free to email me. I'll put my email in the chat, or you can, and I can either refer you to Joe, or maybe there's some sort of other way we connect people. But as always, I can be your main contact if anyone has any questions or anything else they want to know about this subject. And I'll be sure to send any questions I can answer to Joe himself. But okay, well, thank you everybody. We'll see everyone next month for our next segment in our series. Thank you, Joe.
All right, thank you very much. Have a good one.